Gifts and inheritance tax. Is it better to be gifted or to inherit money? Okay, so we're going to be breaking this down today and helping you understand potentially what are the most tax efficient ways for you to pass money on to your beneficiaries and avoid UK inheritance tax at 40%. So to start off with a baseline here, I'm going to go straight to the UK government website, how inheritance tax works, threshold rules and allowances. Now, I'm going to skip straight down to the table here, which explains the tax rate. So any gifts you give in the 3 years before you pass away, the UK government doesn't count these. You still get taxed at a full 40% and they form part of your estate for inheritance tax purposes. As you can see after that, there is a sliding scale. If it was 3 to 4 years before your death, there's a gift tax rate of 32%, 4 to 5 years, 24, 5 to 6 years, 16, 6 to 7 years, 8, and 7 years or more, 0%. So, what does this mean for you and potentially your beneficiaries? So, say you're age 50, you've amassed quite a lot of capital during your lifetime, or you know that you're going to be over you're going to be over inheritance tax, I should say, in the United Kingdom, which is £325 per individual or £650,000 per couple. May sound like large sums of money, but by the time you take any property, main residence, even with a main residence exemption, any other assets you have, bank accounts, etc., it's very easy to go over these thresholds. So, if you're say 50, and you have, say, £500,000 sitting in other assets that are not tax efficient, such as a SIP, which is free from inheritance tax, you potentially could gift a part or all of that capital to your beneficiaries. Now, obviously, there is the risk and the chance that you could die. At the age of 50, you would have to reach age 57 before it would be 0% rate gift tax on those gifts. But obviously you'd have to look at what you think is your life expectancy. Are you in ill health? Do you have anything coming? Of course, nothing can be predicted. Something terrible could happen, you could have a serious illness and you could pass away. But statistically speaking, it's probably far likelier that you will live on into your 70s, 80s and 90s. As such, gifting can be a fantastic way of reducing your inheritance tax bill. You want to know the other funny thing? It doesn't cost you a penny. The financial advisor doesn't earn anything by you making gifts. I don't know, maybe some financial advisor charge for reports talking about gifts. I mean, here at Cameron James, when we're talking about clients and they're doing gifting, it's a decision which they make on their own, based on their own understanding of their health, etc. A lot of financial advisors, when you go to them with an inheritance tax problem, the very first thing they'll do is go and pick the most complicated trust structures in the industry. Trusts can be fantastic, can be very well used, but they're also very expensive. And they also lock you into basically using that trust, or your beneficiaries using it for a very long period of time, which is very good news for the person who's managing that account, and they can be quite expensive to run. So I always say to my clients, you're better to give with a warm hand than to give from a cold hand from the grave. If you've earned all this money and you've worked very, very hard, it can, for some people, be more beneficial and more enjoyable to watch their children, their beneficiaries, their adult children, enjoy that capital, get them onto the property ladder, help them out in life. It's not the same as when you were in your 30s buying a house in the UK compared to what your salary was then. People are getting squeezed now. In the UK, it's extremely difficult to get onto the property ladder. Again, this is not advice and it comes down to your own independent situation, but gifting is a fantastic way to avoid inheritance tax. Now, if you were to not gift and say that £500,000 went into your estate, and when your beneficiaries or the executor of your will goes through probate, that £500,000, if you're over, say you had £650,000 of other assets as a couple, and this extra £500,000, this £500,000 would be taxed at 40%. That means £200,000 would be payable in order for that money to be passed on to your beneficiaries. That's a very large sum of money. There's other things you could do. Maybe you could take out life insurance to cover the liability of the £200,000. Again, that's an expense. It's an ongoing monthly cost during your retirement in comparison to something such as gifting. Now, I'm making gifting sound amazing and whatever. Of course, there are risks with it if you gift and then you were to pass away. But at the same time, the tax rate in the first 3 years is only the same as what the tax rate would be if you hadn't have gifted anyway and you had have just left it in your estate. So I think gifting is extremely valuable for clients, and we always try to start off from this point when doing inheritance tax planning. After that, there's 5 or 6 or 7 other tools and solutions that we can help our clients understand and look through, including insurance, discretionary based trust, etc., etc. There's many things we can do, but we try to keep it simple and stupid. Not to do ourselves out of a job and do ourselves a disservice. Yes, we can make money from helping people by using those other tools and solutions, but gifting should always be a fundamental part of this conversation when talking about inheritance tax. If you want to have a conversation with myself or one of our senior financial advisors about your estate, your beneficiaries, how you're planning to pass things on, kindly book envelope via the description section to have an appointment with myself or one of our senior financial advisors to explain in detail how we can help you. And as always, take care with your UK pension assets.